All right, hello everyone. Welcome to the first Opes Trading Group psychology course. It's Philip here. I'm happy to have you all with me. And from the poll that we had on the Telegram chat, the majority decided that you guys want to talk about the 4 fees of trading, and that's what we're going to go through today. So just before we get started, on this PowerPoint, which have the disclaimer and the copyright, this is purely for educational purposes only, everything I'm doing here. So the 4 fees of trading. Now, guys, write in the chat, what do you think some of those four fees of trading may be? I just want to see how many of you have probably experienced those 4 fees in your trading. Fear of missing out. Yes, that's correct. That is definitely one of them. Entering when I see a signal. Yeah. Okay. So here we have the 4 fees of trading. So we have the fee of losing money, the fee of being wrong, the fee of leaving money on the table, and the fear of missing out, which is FOMO. Now, if we look at the first fear of trading, which is the fear of losing money, this is probably one of the biggest things that people do experience in trading. It's probably one of the main reasons that a lot of traders, stuff up their trades, or their trades may not enter or exit trades based on the simple fear of losing money. So people are actually preparing themselves for failures and doing so by having that fear. You cannot have a fear of losing money. If you are trading, you have to understand that everything we are doing is simple probabilities. And when you have a probability system and an edge that works, the fear of losing money does not exist at that point because you believe in your system and in your edge. So the fear of losing money is one of the key things that any trader may experience as they begin their journey in trading. I'm sure a lot of you guys, a lot of you when you first got started on your trading journeys, placing your first trade, especially with a live account, you would have experienced the real fees of seeing your capital fluctuate, especially when it goes into a drawdown, when your trades are in a negative, your brain triggers into having that fee that you may lose that money that you have in there. And that is simply because you have not yet understood that trading is probabilities, and losing money is actually, believe it or not, part of trading and part of the game that we are in. So that is the first fee of trading. The second fee is the fee of being wrong. So ego plays a critical role in trading. And as you may hear it, as you may have heard me say it plenty of times, if you don't leave your ego aside in trading, it's going to greatly affect what you do on the charts. For the people that actually have a fear of being wrong, that cannot admit that their trade is actually going against them. Some people may not admit that the initial analysis that they have is actually incorrect or not going according to what they thought. What does that then do? What do you think that may lead to? As you know, that's when people start, for example, moving their stops because they have a fear of actually being wrong. They have a fear that if the trade ends up reversing from a certain area, that they would have got stopped out. So what does that do? They move their stops. By them moving their stops, what happens? Their risk is growing. the analysis they had on their trade isn't valid anymore, and their drawdown is only growing. And where does that stem from? Where does that fee actually stem from? That fee actually stems from the ego that traders usually have. One thing that a lot of traders really need to conquer and need to work on, I believe, is the ego. Because what a lot of people do is they have their pride, they have the fear of being wrong. They cannot admit, even when others are telling them certain trades may not look right, or they point out a clear trend that they are in the opposite direction to, their brain will actually fail to recognize that they are in the wrong direction of that trade. And what happens in that instance is their drawdown only grows. The fear of being wrong causes them to move their stops. The risk is increased. And all these things lead to the probabilities or the edge not working at that stage. So you have to think that if you have a certain system in place and you are taking risk reward trades, let's say of 2-to-1 risk to reward trades, you're going after that, you have, let's say, a ratio or a strike of getting 70% or 60% of your trades correctly. If one of those trades is actually meant to be one of your losses, and you have now played around with your stop, your risk is moved from being, let's say, 1%, you've increased it to 2% or 3%. This single trade is now directly affecting all your winning trades and affecting your edge and your strategy as a whole. And all that stems from the fear of being wrong. If you cannot accept that you are going to have losses and you are going to be wrong, then that's going to show and affect you greatly in your trading. So this is one of the fears that a lot of you and a lot of traders have to really work on. It's your ego and actually accepting that losses are part of the game. The next fear is the fear of leaving money on the table. So it's not only the losses that are the product of fears, but cutting winners short is another product of fear also. So how many of you here have actually cut a trade short or cut a trade way too early only to see it run in your direction to exactly where you predicted it will go to? And I can probably guess that that would be every single one of you. Right? So that is all stems from the fear of leaving money on the table. And do you guys actually know why that fear is there? That fear is simply there because you are looking at money as a dollar value. You're not believing in your edge. You're not believing in your analysis. You're not chasing pips. That fear stems because you are seeing dollar figures. And there's a saying that says, cut your losses short and let your winners run. And now you can understand that why do people let their losses run and cut their winners short? That is because of the fear itself. Because when you're in a loss, you have the fear of being wrong and the fear of losing money. So people will keep moving their stops because they don't want to have a loss. They don't want to let go of their money. And then why do people cut their winners short instead of letting them run? That is because of this fear, which is the fear of leaving the money on the table, because they see the dollar figure. Whatever account you are trading, you're going to have a different dollar figure, even if it's the exact same trade. Some people may see they are $500 in positive, let's say, and they might want to take it out because they're looking at the $500 as something tangible and material, and they want to take the $500, even though their target is $2,000. People trading bigger accounts may see $20,000. Yes, $20,000 may be a lot of money, but hang on, the target is at $60,000. So what you are doing is you are failing to recognize your edge, your analysis, and your trading as chasing simple pips. And you have now involved the fact that there is a dollar value and money that you can see, and that is causing that fear of leaving the money on the table. Do you guys understand where I'm getting at here? Do you guys understand that the quote, cutting your losses short and letting your winners run, are you understanding where that stems from now? And as you may all know, that all the market moves is based on two emotions, two simple emotions. There is fear and there is greed. Greed is equally as bad, but this is what we're talking about today. We're talking about the four fears of trading. So what I wanted to say is you need to be completely at peace with losing, with your losses. And you need to be completely at peace with letting your winners also run. Unless you have a very valid reason that you can see on the charts for you to close your trade early, or to close half a position or any percentage of a position, then you are thinking in terms of the charts. You're not looking at the dollar value. If the charts are telling you, hey, this might be a good area to get out a bit early, well, that is when you actually look at your chart and you do follow what the charts are trying to tell you. So why do a lot of people, for example, close a trade early and then it goes in their direction? It's actually very simple. It's because they have not completely accepted the loss. That is another thing that a lot of you guys and a lot of traders need to work on. It's to actually accept the loss that you have placed. If you have set a stop loss of any figure, $100, $1,000, $10,000, $100,000, you need to be completely at peace and completely accept that that is the loss you have placed and that is what you are risking. If the trade hits the stop loss, so be it. You are completely at peace. You've accepted it. You understand that trading is all about probabilities, and you understand that the next trade that comes along, that may be a 2-to-1, is going to make back that loss times 2. Now, this is the last fear, and I'm sure a lot of you guys have heard about this. A lot of you have read about it, FOMO, the fear of missing out. So this is actually one of the most common fears, the fear of missing out. It leads to too many people. What do? Enter a trade too early, enter too late, enter without their edge, without confirmations, just simply because of the fear that they will miss out on a certain or particular trade. So I'm sure every single one of you have experienced it in one way or another. And this, once again, comes back to you having your edge, understanding your edge, understanding where your entries are going to be, where your exits are going to be, understanding the price action, certain areas, how is the price reacting? Is it giving you the correct signals? Have you entered blindly? Has the market, has the candles gave you a reason and to actually support the edge? One thing you guys got to remember is that if anything happens in the market, it most likely is going to give you a second and a third chance to enter. Rarely have I ever entered a trade where if I had waited 5 seconds later, I would have missed out completely on the whole trade. You have to think you always have a chance in one way or another to enter the trade. So you have to actually look within, see where that fear of missing out is stemming from within you. Is it because you're going to miss out a certain trade on a particular day? Is it that you're not going to miss out on a trade? Where is it stemming from? Is it because you want to enter early because you feel like it might turn at a certain spot, and even though you're looking at the chart and you know this looks like it is going to say go higher or lower? Or a lot of people just see the price has already moved, the move has already started, then they say, I don't want to miss out on this, I want to enter. But they fail to recognize that trades are always coming. If you missed out on a trade, it's only a certain amount of time before the next one comes along. So the fear of missing out is a fear that's really not necessary, because there is always a chance on the markets. And you got to remember, if it's not the same day, it's the next day. If it's not the next day, it's the next week. It is better to miss a trade than to actually add a trade which fails to your system, because surely that's not part of your edge to start off with. And you have to understand that when you enter a trade too early or too late, you're actually playing around with your edge, because now your risk to reward, your whole system doesn't work anymore. Your stop loss isn't at the level that you initially wanted it to be. You now have a bigger stop loss, a smaller TP. Your risk to reward is not as great as it should be. And you've done all this simply because of the fear of missing out. Now, don't get me wrong, some people enter early or enter late, and the trade may still work for them, but they've actually decreased their risk to reward. They've increased the chances of a failing trade. And all for what? All for the fear of missing out. That is simply what it is. The simplest way to put it is you have to understand, you have to believe, what you have to believe in as a trader is you have to believe in your edge. You have to believe in your edge, know what your edge is, have your confluences on a trade. Once you do that, you set your risk. And then after that, you set your take profit. And that is all trading really is. So this is a quote that I've actually heard from Mark Douglas. It's fear narrows your perception. You will focus on the fear so much that it will often create the experience you are trying to avoid. I'm going to say that again. So fear narrows your perception. You will focus on the fear so much, you will often create the experience you are trying to avoid. And I wanted to look at this chart, for example. So we have a trend line on this Euro NZD chart 4 hour from this point to this point, and this single candle over here came down, hit the trend line, created a nice pin bar, and many people would have thought this may be a nice area for a buy, this may be a nice area for a long. You know, you've also got an area of support over here, you know, supply and demand area. Looks nice for a short, your edge is there, you've got your Fibonacci with the 78.6. Everything looks nice, you've got your edge. You place your stop loss below the 100% or below the low, the previous low. You have your stop loss here and you can place your TP at the highs, for example. Great, this is your edge. Now what happens? This trade starts going down, breaks a bit below the trend line. Every single one of you, or a lot of you, at one point or another in your trading journeys, would have thought, okay, this is just breaking, it's going to come back in. Then as it starts getting close to your stop loss, you say, okay, I'm going to move my stop loss because this may just do a double bottom and then come back up. Then you'll see these candles happen over here, and this starts moving in an upward direction. And you'll say in your head, I knew it. This is going back up. I knew it. This is a double bottom. Then you'll see the price start moving down again. Once again, you'll get scared because your stop is there. You'll have that fear. And then the price will reject once again. And then you'll say, I knew it. This is a double bottom. This is going up. As the price starts moving back down, you'll see it nearing your stop loss, and you'll say, there is a low over here. Maybe I should move my stop loss because it's gonna reject that low and then go up. And just as you predict, it will reject the low, it will give you a nice price action, move back up. And now you're feeling those feelings of euphoria again. The fear is going and you're feeling the euphoria again. And then it will come back down. And at this point, you're looking at your stop loss and you know that there is no more lows to go under. And this is where you will go into panic mode because you don't know where to move your stop. You're now recognizing that the risk you initially had, which was here, has now almost tripled. You will look at your drawdown, you will look at your loss, and you are now seeing the panic and the fear in your trade. Once you get out of the trade, once the trade hits your stop loss, I'm going to go back to the quote that I had. Fear narrows your perception. You're going to focus on the fear that you're going to create the experience you're trying to avoid. Looking at this here, throughout the whole bearish move, fear had narrowed your perception to a point where you actually completely missed that the whole trend had changed and you're actually creating lower highs, lower lows, and the trade is now moving in a bearish direction. Every time you see a red candle on the chart, your fear is kicking in. And the euphoria is caused by every little blue candle, whether it's on the 5-minute, 15-minute, any candle you can imagine that is blue or green as a bullish candle, is now going to cause these feelings of euphoria. And when you're having those feelings of euphoria, your mind is completely missing that the trend has actually completely changed directions. And it is only when you hit the stop loss and you are not in the trade anymore that you will look at the chart and you say, wow, how did I miss this? How did I fail to recognize that this trend has actually completely changed direction? Now, in saying that, was your edge wrong at this point? No. Your edge was not wrong. This just happened to be one of your losing trades, and you have to accept that loss. And if you fail to accept the loss, well, you see what's going to happen. You're only going to increase your risk, and you're going to risk 3 to 4 times more than what you originally had planned. So when people say you have to be emotionless in your trading, it is true, because you can see what emotions are doing on this chart. You are focusing so much on these little bullish moves. You are actually believing, your mind is making you believe that this little move is going to bring you back all the way to here. This little bullish move would have made you believe the same thing. And because of your emotions, and you're not trading emotionless, you have actually failed to recognize a whole trend change in the market. You cannot stick with the mindset that you're going to be certain about outcomes. There is no such thing as certainty. And the only reason in this chart, for example, you would have moved your trades is because you wanted to be certain. You had the fear of losing money. You had the fear of being wrong. You wanted to be certain about the outcome that's going to happen. And you actually didn't believe in your edge. If you truly believe in your edge, you know that your strategy and your edge is going to have losses. There are certain traders that have a 40% winning rate of trades, but they are still profitable. And that all comes down to because they have an edge that they trust in, believe in, do not deviate from, and they know that their trades are 5-to-1 trades. And all it takes is one single trade to really set you back. The amount that sets you back is depending on how much you risk to start off with, how much you moved your stop. But you actually have to understand that one single trade is really going to ruin, whether it's days, weeks, months, or even years of what you've been working for. And if that happens, well, then your whole edge doesn't work. You have to understand, you have to truly believe, and you have to be so disciplined that you have to treat every single trade the exact same. You can risk differently on different trades. You can have rules where if there is a certain amount of confluences on one trade, you will risk a little bit more on it, let's say. That all depends on the person and their rules, but you need to create a set of rules that you are comfortable with as a person, as a trader. You have to believe in your strategy, your edge, in order to do so. But all it takes is one trade where you break your rules, and then all the wins, all the profits you have made are just going to disappear. And then what happens at that point? Then emotions kick in even harder, even more. The fear kicks in even more, because now you have lost your profits, you have lost money, you've lost capital. And then you are susceptible to create even more mistakes to make that money back. And don't get me wrong, there are people that do end up making their money back by taking, over risking or over leveraging. But sooner or later, they will come back and fall back into the same trap. You have to understand that making money consistently is a byproduct of mental skills that you learn and apply. You have to understand that it's important to step aside and trade for the reasons of actually having rules and following those rules and rewiring your mind to be disciplined and eliminate the fears that we just spoke about. So how do we actually remove fear from trading? Well, the first thing that we already spoke about is you have to be completely at peace with losing a trade. If you are completely at peace, and a lot of people, they think they are at peace with losing a trade until the price is near their stop loss, and then they realize that they're really not at peace with losing the trade. You have to be completely accepting of that trade, and whatever happens, happens. And that comes down to believing in yourself and in your trading once again. Because if you believe in your trading and you know that you can get 6 to 7 out of trades correctly at 2 to 1, well, why does the loss even matter? The next thing is knowing the difference between confidence and euphoria. Confidence is actually knowing and believing in your strategy. You need to actually be confident in yourself as a trader, what you're capable of, your edge, your confluences, your backtesting, the time you have been trading and analyzing charts and being in the markets. Whereas euphoria is when people actually get a certain amount of trades right, whether it's a couple of trades, and then they think they're on top of the world. One way to really get destroyed by the markets is to think you are better than the markets and to think you've understood the markets. So that you have to actually understand the difference between confidence and euphoria. There is a big difference and it's a fine line. The next point is understand what it means to think in probabilities. If you understand probabilities, and this is another topic of psychology, if you actually understand probabilities itself, you actually understand that you don't need to have fear. Believe deeply that at any time, anything can happen. How many of you actually truly believe that at any time, anything can happen? And every moment is unique. A lot of people see certain patterns and certain formations in the markets, and they think just because they have seen it hundreds of times before that at this time the exact same thing is going to happen. That is because they don't believe deeply that anything can happen, and they don't believe that every moment is unique. Yes, the pattern may look the same, the chart may look the same, it may have happened the exact same way before, but every moment is unique in the markets. And this may be the time that this doesn't happen. And if you have over leveraged, over traded, your fears kick in, your emotions kick in, well, this can be the one trade that goes wrong for you, and it can really hurt you at the end of the day. Removing emotions from your trading is really a major, major aspect. There's a reasons why, AIs and algorithms can trade without having the emotions. There's a reason why they can trade and follow an edge and follow the probabilities of an edge better than a human. And that simply comes down to the point that they have no emotions. They follow their rules. If something happens, they enter. If something else happens, they exit. They have a strict set of rules they don't deviate from. They don't deviate from them because they don't have emotions. And you have to understand that your emotions are the cause of so many failures and losses in the markets for you. And once you do all these things, then you can really remove the fear from your trading. Once you remove fear, you've removed emotion. And once you've done that, then if you have you still got to have a proper edge in place. You need to have a strategy that works. If you have a strategy and an edge that works, and you've eliminated fear and emotions from your trading, emotions also being the greed aspect, then you are literally just repeating the same process day in, day out. You may take some losses, but overall, your equity curve is only going up because you have a system and an edge in place that has been proven to work. You don't care about the one trade that goes wrong or even the 5 trades in a row that go wrong, because you truly believe in yourself that over time, you're going to have more winners than losers. You're going to make more of a profit than a loss, and you're going to end your day, your week, your year on a positive note. That's pretty much all there is to the 4 fears of trading. Guys, I want you to just open up your chats. If you have any questions, I'm happy to answer them now. Have any of you experienced any of these, or a particular scenario that you'd like to ask or discuss with the rest of us, or just simply put out there? Anything? Something I found interesting with bank traders is the indifference to loss. Yes, that is very, very true, and that is correct. You cannot be attached to losses. You really need to actually be at peace and accept them. How do you deal with leaving profits on the table? I tend to have this problem a lot of the time. Leaving profits on the table, do you mean where you exit too early and then you left profits because you didn't let your trade run? Or do you mean that you left a trade and let it go back to your entry and knock you out at break even? When it's someone else's money, it becomes so much easier to think in probabilities. Yes, and exactly. And when you're trading for banks, for example, I bet that it would be a lot easier, that a lot easier to think in probabilities and actually accept the trading and believe in the system, because now you're not chasing money for yourself, or you need to make certain amounts or certain goals that you need to hit in your own head because of that. I let a trade go back to break even without banking any profits. So this, once again, that will probably come down to your edge. If you have a certain set of rules in place where you're taking out profits at halfway, you're not going to have that problem of letting trades go back to break even. If you're finding that most of your trades are going back to break even, well, that really comes back to your edge, and that just means that maybe your TP is a bit too far, and that you need to be adjusting your analysis in your trades in that aspect. All right. I'll let it go back to break even without breaking. Yep. All right, guys. I'd like to thank you all for joining the first psychology webinar. Thanks a lot for participating, and I'll see you guys on the next one.